Welcome back. We are so thrilled you could join us today for a brand new deep dive.
Yeah, it is really great to be here. We have a lot to cover.
We really do. We've got a topic lined up that feels, incredibly relevant right now, especially when you look at the macroeconomic indicators flashing across our screens lately.
Oh, absolutely.
We are going to be talking about your financial future, your peace of mind, and specifically the structural integrity of your retirement strategy.
Which is something I think everyone is, or at least should be thinking about right now.
Exactly. Our mission for this deep dive is completely focused on demystifying how you can actually safeguard your hard-earned retirement assets using physical gold.
Right.
And more importantly, we're going to explore how to do this without getting completely lost in the dense, intimidating financial paperwork that usually act as a barrier to entry.
It is a subject that requires some really careful navigation.
Mm.
I mean, when you start talking about moving retirement funds out of the traditional financial system and into physical assets, people understandably get nervous.
Yeah, for sure.
There is a whole new landscape of rules, regulatory compliance, and just the sheer mechanical logistics of how it all works that you don't really face when you're just, clicking buy in an index fund.
Which is exactly why we aren't just winging the discussion today.
Definitely not.
We're pulling our insights from a highly credible, comprehensive bulletin and comparative market analysis compiled by Doug Young.
He's a fantastic resource for this.
He really is. Now, to give you some context on why his research is the backbone of today's deep dive, Doug is a financial markets researcher with over 20 years of experience in the field.
Yep.
He actually spent 16 years as a financial director, and he has spent over 15 years specializing specifically in the nuances of gold IRAs.
That level of focus is rare.
Right. We are talking about someone who has conducted over 80 meticulous evaluations of gold IRA companies since 2011. He knows exactly where the regulatory tripwires are.
I've seen it all.
Okay, let's unpack this. What exactly is a gold IRA? We hear the term tossed around a lot in financial circles.
We do, yeah.
But stripped down to its core, a gold IRA rollover allows you to transfer funds from an existing retirement account, like your standard 401k, a traditional IRA, a Roth, or a SEP IRA, which is usually for self-employed folks, directly into a gold individual retirement account.
Exactly.
And the crucial element here is that you execute this without taking a tax penalty.
If we connect this to the bigger picture, you have to look at what traditional IRAs are fundamentally built upon to understand why this matters.
Right. Let's talk about the foundation.
Traditional retirement accounts hold paper-based assets. We're talking about equities, corporate debt, mutual funds.
The usual suspects.
The usual suspects, exactly. And while those have historically been the standard engines of retirement growth, they are inherently tied to the financial system.
They are completely enmeshed in it.
Right. They carry counterparty risk, and they are highly vulnerable to market volatility. A gold IRA flips that script entirely.
Because it's a hard asset.
Yes. Instead of holding paper that represents a fraction of equity or a promise of debt repayment, the gold IRA holds a tangible, physical asset.
I was looking at Doug's notes on the 4 main benefits of doing this, and the first one he highlights is inflation protection.
A big one.
Huge. Now, we all know the general concept that when fiat currency loses its purchasing power, gold tends to hold its ground. But it's more than just a vague correlation, isn't it?
It is a deeply historical relationship. When central banks increase the money supply or when inflation runs hot over a sustained period, the actual purchasing power of your paper dollars erodes.
You feel it everywhere.
You see it everywhere from the grocery store to housing. Gold, conversely, is a finite physical resource.
You can't just print more of it.
Exactly. Because it cannot be printed into oblivion, its valuation often moves inversely to the strength of fiat currency. In a retirement context, holding an asset that acts as a counterweight to inflation helps you maintain your actual real-world purchasing power over the decades you will be relying on those funds.
That makes total sense. And that leads right into the second benefit Doug outlines, which is diversification.
Yeah.
Now, we aren't talking about the standard advice of just shifting allocations between tech stocks and blue chip stocks. Doug's research highlights how critical, true, uncorrelated diversification is right now.
That is the operative word, uncorrelated. By including physical gold in your retirement strategy, you are decoupling a portion of your wealth from Wall Street entirely.
You're stepping outside that bubble.
Precisely. You are spreading your investments across asset classes that operate on fundamentally different economic drivers.
Right.
If the equity markets take a sudden severe dive due to algorithmic trading sell-offs or a systemic banking issue, your gold holdings aren't mathematically tied to that panic.
It's an entirely different playing field.
It structurally reduces the risk of taking catastrophic losses across your entire portfolio simultaneously.
I see the appeal of decoupling, but what about the tax implications? That is usually the very first thing that makes investors hesitate.
Oh, absolutely. Taxes are the big fear.
But according to the bulletin, a gold IRA isn't some rogue, off-the-grid financial experiment. It offers the exact same tax advantages as traditional IRAs.
That's right.
So your contributions to a gold IRA can be tax-deferred, meaning you aren't paying taxes on your gains until you start taking distributions in retirement.
And there's the Roth option, too.
Yes, if you opt for a Roth Gold IRA, you are looking at the potential for completely tax-free withdrawals down the line.
And that preservation of tax advantage status brings us to the fourth overarching benefit, which is security.
The safe haven aspect.
Exactly. The research explicitly frames gold as a safe haven asset during periods of severe economic anxiety. When we see extreme market volatility or enter a prolonged bear market, capital tends to flee risky assets and seek shelter.
They want safety.
Gold has a deeply entrenched historical tendency to absorb that fleeing capital and hold its value.
But wait, I do want to push back on that slightly. Gold isn't completely immune to volatility.
No, not at all.
It is still a commodity. Its spot price fluctuates daily based on global demand, mining yields, international trade.
That is a critical point, and it is one the source text is very careful to clarify. Gold prices absolutely can be volatile in their own right. It is not a magic wand that guarantees a straight line of upward growth.
Right, it's not a risk-free asset.
No. That is why Doug's research heavily stresses the importance of balance. No credible analyst is suggesting you liquidate your entire portfolio of equities and bonds to hoard physical gold.
That would be reckless.
It would be. A gold IRA should be utilized strategically to balance your other investments. It's a tool for mitigating your overall risk profile, creating a more resilient aggregate portfolio.
I want to pause here and connect this directly to you, the listener. Think about your own retirement portfolio right now, the one you've spent years building.
Really picture it.
Imagine logging into your account tomorrow morning and seeing that a sudden, severe macroeconomic shock has wiped out 20 or 30% of your paper assets overnight.
It's a terrifying thought.
We have seen it happen in 2008. We have seen market circuit breakers trip more recently. How would your current setup handle that kind of systemic shock?
Most wouldn't handle it well.
Introducing the concept of a tangible safe haven into your strategy isn't just an abstract financial exercise. It's a deeply personal question about how you engineer resilience and whether you want a portion of your life savings completely insulated from the whims of a stock market crash.
It is about engineering peace of mind. But as with any strategy involving the IRS and tax-advantaged accounts, building that resilience requires navigating a highly specific and often unforgiving set of rules.
Here's where it gets really interesting, the fine print.
Oh, the fine print is where they get you.
Because the regulatory landscape here is intense. Making a procedural mistake doesn't just mean a minor headache. It can trigger severe financial penalties that wipe out the very security you were trying to build.
It defeats the whole purpose.
Doug's bulletin spends a lot of time breaking down the mechanics, specifically the massive difference between a transfer and a rollover. A lot of financial media uses those words interchangeably, but to the IRS, they are two wildly different mechanisms.
They are completely different logistical processes with entirely different risk profiles. Let's start with the transfer.
Okay, the transfer.
A Gold IRA transfer involves moving funds directly from your current account custodian to your new Gold IRA custodian. The money travels directly from institution to institution.
So you never actually touch the money yourself.
You, as the account holder, never actually take personal possession of the funds. The research strongly notes that this method is generally considered safer and substantially more straightforward.
Because there's no middleman step.
Because the money never touches your personal bank account, the risk of accidentally triggering an early distribution tax penalty is effectively eliminated.
Okay, so a transfer is the clean, direct route. But what about the rollover? Reading Doug's notes on this, it sounds like navigating a minefield.
A rollover is absolutely where the danger lies for the uninformed investor. In a Gold IRA rollover, your current retirement account provider actually liquidates the requested funds and cuts a check directly to you.
So you actually get the money in your hand.
You take personal possession of the capital. And the moment those funds are in your hands, a countdown clock starts ticking immediately.
Uh-oh.
You have exactly 60 days to deposit those funds into your new Gold IRA account.
It is basically a ticking time bomb. You are just holding a check for a massive portion of your life savings, watching the calendar. What happens if there's a banking delay or you just miscalculate and hit day 61?
If you miss that 60-day window by even a single day, the IRS ceases to view the transaction as a rollover.
Wow.
They classify it as an early distribution. Suddenly, you are facing strict tax penalties on that entire amount, plus the standard income tax you will owe on the distribution.
That could be devastating.
It can be a devastating financial blow. Now, the research does note one specific rule regarding rollovers. There is no limit on the number of rollovers you can perform in a given year.
Oh, really?
The IRS doesn't restrict the frequency, but they are completely uncompromising on that strict 60-day rule every single time.
Given that massive penalty cliff, it seems like a direct transfer is the way to go unless you have a highly specific strategic reason to need the liquidity for a few weeks.
Usually, a direct transfer is the path of least resistance.
Let's pivot slightly and talk about the limits for getting fresh capital into these accounts. The IRS updates these figures periodically, and the bulletin gives us the specific numbers for the year 2026.
Right, the new limits.
For individuals under the age of 50, your contribution limit is $7,500.
Okay.
If you are 50 and older, you qualify for a catch-up allowance, bringing your limit to $8,600. But the crucial part Doug points out is that this limit is cumulative across all of your IRAs.
Exactly. You cannot max out a traditional IRA with $7,500 and then decide to drop another $7,500 into a Gold IRA in the exact same tax year.
It's a shared pool.
That cumulative cap requires you to be highly strategic about your asset allocation when making annual contributions. Now, alongside contribution limits, we also need to have a very frank discussion about the costs.
The hidden catch.
This is the catch. Structurally, Gold IRAs carry different and generally higher fees than your standard traditional IRA.
Which makes sense, right?
When you have a traditional IRA holding digital index funds, the maintenance cost is negligible, often it is a tiny fraction of a percent in expense ratios. But with a Gold IRA, you are dealing with heavy physical metal that requires logistics.
Wait a second. If I am paying steep ongoing fees just to hold the asset, doesn't that inherently eat into the inflation protection that gold is supposed to offer in the first place?
That is the critical trade-off every investor has to weigh. You're going to face transaction fees when executing the buying or selling of the metal within the account. But the most significant ongoing overhead will be storage fees. The IRS strictly mandates that you cannot take personal possession of the gold in your IRA.
So I can't just keep it in a shoebox under my bed.
You cannot keep it in a shoebox, and you cannot put it in a personal safe deposit box at your local bank.
Really?
Yeah.
Not even a bank deposit box?
No, it must be held in a highly secure, IRS-approved depository facility.
We are talking about serious cinematic levels of security here, right? Like an Ocean's 11 style vault.
Quite literally.
Okay.
These are specialized third-party vaults with armed security forces, advanced climate and access control, and comprehensive specialized insurance policies that cover the full value of the physical assets.
That sounds incredibly expensive to maintain.
You, the investor, have to cover the annual cost of that specialized storage. You are trading the near-zero maintenance costs and systemic vulnerability of paper assets for the structural security and tangible storage costs of physical precious metals.
And speaking of the IRS being particular, I was looking at Doug's notes on what you can actually put in these high security vaults. I assume I can't just buy a vintage gold watch or some historic coins I found at an auction and declare them part of my tax-advantaged retirement account.
Not even close. The objective of the Gold IRA is to hold highly liquid, recognized financial instruments, not subjective collectibles.
That makes sense.
The IRS has incredibly strict metallurgical purity standards that must be met.
I figured as much. What are the actual numbers?
For gold to be eligible for inclusion in the IRA, it must be 99.5% pure.
99.5, okay.
The text highlights that this includes specific approved bullion, like American Gold Eagles, Canadian Gold Maple Leafs, and certain bars from accredited refiners.
What about other metals?
Interestingly, if you want to diversify the account into silver, the standard is even higher. It must be 99.9% pure.
Wow, even purer.
And if you are looking at adding platinum or palladium, the requirement is a staggering 99.95% purity.
That is incredibly precise. I imagine if you try to do this yourself and accidentally buy a coin that is only 90% pure, like an older Krugerrand or something, you are instantly violating IRS rules
You are.
and setting yourself up for those exact same distribution tax penalties we talked about earlier.
Which perfectly illustrates why navigating this landscape requires professional infrastructure. The sheer volume of regulatory tripwires, from the 60-day rollover ticking time bomb to the specialized depository requirements to the strict purity standards, makes this virtually impossible to do safely on your own.
Which brings us to execution. How do you actually get this done without stepping on a landmine?
You need a plan.
Doug Young's research outlines a highly structured 5-step playbook for executing a rollover or transfer properly. Step 1 is fundamental: gather information.
Don't skip this step.
Before making a single move, you need total clarity on your current asset allocation. You need your account numbers, exact balances, and a firm understanding of what you are currently holding so you can determine how much you actually want to decouple from the market.
Step 2 is where the architectural decisions are made. Selecting a Gold IRA company and a custodian.
Right.
What's fascinating here is the deliberate separation of powers mandated by the process. It is a structural division designed to protect the investor from fraud and ensure total IRS compliance.
It's a system of checks and balances.
You are fundamentally dealing with two entirely separate entities.
Let's break those two down, starting with the Gold IRA company.
Think of the Gold IRA company as your project manager or specialized broker. They oversee the entire onboarding process.
Okay.
They educate you on the options. They assist you with the actual procurement of those IRS-approved, highly pure metals. And they do the heavy lifting of coordinating with the various financial institutions.
So they are the facilitators.
But, and this is vital, they do not hold your money and they do not hold your gold.
That is the custodian's job.
Exactly. The custodian is a specialized, heavily regulated financial institution. They are the entity that actually holds title to your physical assets within that approved high-security depository.
They are the vault keepers.
They manage the complex IRS reporting, they issue your official account statements, and their primary mandate is ensuring that your account remains in strict compliance with every single IRS regulation.
That's a huge responsibility.
While your Gold IRA company will likely recommend a trusted custodian they interface with frequently, the ultimate choice of who holds your assets remains entirely up to you.
That division of labor makes a lot of sense. The people selling you the asset aren't the ones guarding the asset.
It protects everyone involved.
Once you have your company and custodian locked in, step 3 is to choose your investments. This is where you actually select the American Eagles, the Maple Leafs, or the approved bullion bars.
Right.
And having that Gold IRA company acting as a filter is crucial here to ensure you don't accidentally select a non-compliant asset.
They keep you strictly within those purity rules we discussed.
Step 4 is to initiate the rollover or transfer. This is where you contact your current provider, and your new Gold IRA company steps in to guide the paperwork, ensuring the capital moves flawlessly without triggering a taxable event.
And finally, step 5, monitor and adjust.
It's not just a set it and forget it thing.
Just because you have physical metal sitting in a vault doesn't mean you can completely ignore it for the next 2 decades. You need to periodically review your asset allocation, stay informed about macroeconomic trends affecting commodities, and evaluate whether your portfolio remains balanced.
Right, checking in on the broader picture.
The bulletin even suggests that as your account grows, you might strategically diversify further by adding some of that highly pure silver, platinum, or palladium to the mix.
Now, regarding who to trust to guide you through this complex 5-step playbook, Doug Young's research doesn't leave us guessing.
No, he is very clear.
Given the intense regulatory landscape of 2026, he conducted rigorous comparative valuations of the top 5 companies operating in the space.
And there was a clear winner.
Based on his market analysis, a company called Augusta Precious Metals achieved the highest overall scoring. They're his top recommendation for handling the complexities of the setup, ensuring strict adherence to those purity and transfer regulations, and providing the level of operational excellence necessary to make this a frictionless experience.
When you are dealing with a financial maneuver that involves virtually zero margin for error, where a single day late on a rollover or a fraction of a percent off on metallurgical purity can trigger massive tax consequences, aligning yourself with the evaluator's highest scored provider is a highly logical way to mitigate your operational risks.
So what does this all mean? We have covered a tremendous amount of ground today.
We really have.
To synthesize the research, a Gold IRA offers a powerful, tangible hedge against the very real threats of inflation, currency devaluation, and systemic market anxiety.
It's a shield.
It provides a mechanism to structurally decouple a portion of your wealth from Wall Street. But that security demands absolute adherence to IRS rules.
You cannot cut corners.
You have to safely navigate the 60-day rollover window if you don't execute a direct transfer. You have to ensure you are procuring metals that meet incredibly high purity standards.
Yep.
And you have to accept the reality that holding physical wealth requires paying specialized third-party storage fees to keep it in a heavily guarded vault.
It is a calculated trade-off. You are opting out of the zero-cost maintenance and systemic vulnerability of digital paper assets in exchange for the structural security and tangible storage logistics of physical precious metals.
If you are listening to this and realizing that you need to take a much closer, critical look at your own retirement strategy and how insulated you really are, I strongly encourage you to do some further reading.
Highly recommended.
You need to visit the Gold IRA Company's bulletin website. You can find their comprehensive research at goldiracomaniescompared.com. That is goldiracomaniescompared.com.
There is so much more data there.
They have an absolute wealth of related information, in-depth reviews, and further macroeconomic analysis. We have also made sure to put a direct link to this information right in the notes for today's deep dive, so you can easily click through and start exploring the data for yourself.
As we wrap up our analysis of Doug Young's research, I think it is valuable to step back from the mechanics, the limits, the fees, the purity rules, and look at the philosophy underlying this entire financial strategy. This raises an important question.
I always love when we end on these broader philosophical notes. Lay it on us.
We have spent this entire discussion drawing a sharp contrast between traditional paper assets and physical gold. Traditional assets rely entirely on the abstract stability of the financial system, the integrity of corporate governance, and the promises of institutions.
It's a lot of trust. Physical gold, on the other hand, is a tangible asset that has held intrinsic value across millennia. However, as we have explored today, integrating that physical gold into a modern tax-advantaged retirement account requires you to trust and continuously pay third-party custodians and specialized depository facilities.
That's sure.
The IRS strictly dictates that you cannot hold this asset in your own hands. So the question you have to ask yourself as you architect your financial future is this. In a highly interconnected world where every single asset class requires some form of systemic reliance or third-party trust, how do you ultimately define true control when it comes to safeguarding your own retirement?
Wow. That is a heavy, essential question to chew on. Is true control derived from physically holding an asset, or is it knowing your wealth isn't mathematically tied to the next stock market crash, even if that wealth is sitting in someone else's vault? Thank you all so much for joining us on this deep dive. Keep asking those tough questions, keep rigorously evaluating your strategies, and we will see you next time.